You're 63, you've been working your tail off your entire life, and all of a sudden you wake up and you have $1 million or more in tax deferred accounts like 401ks and IRAs. What do? What's the next step? Can you retire? Or what does retirement look like? Well, I'm going to show you. As you can see here, Pete and Mary Health are not on a good trajectory to be able to retire the way they want. And I'm going to show you exactly what has led them to this point now. And we're going to go over a few things that they can adjust to be able to clean this entire retirement situation up. And this is why retirement planning differs from asset accumulation. The first place we want to go is to be able to evaluate those distributions from a 401k and an IRA. And you can see here that for the first few years of retirement, in fact, for the majority of retirement, they're going to be distributing assets in this center column from their 401k and their IRA. And they have $1 million or more. And by the time they retire, they will definitely have more than $1 million in tax deferred account balances. So we're starting to project out their distributions that they're going to need for retirement. We can also start to project out what their taxes are going to look like. You can see in this column, in the early years, their tax bracket, because of their income now as they're working, are in the mid 20% range. Their highest marginal bracket, where their next dollar comes in, is taxed, is at 24, 22, 25, and 25. But you can see here it drops to 15%. And then later in retirement, in their 70s, it bumps back up to 25%. So we're starting to evaluate what retirement looks like by where money is coming from and how much in taxes you're going to pay. But I think now is a good time to go over this scenario. Where are these people at and what does this all look like? How did we get to where we're at now about high distributions and potentially high taxes in retirement? The first place we want to start with Pete and Mary Health. And I should tell you, Pete and Mary are real clients, but I've concealed their names, obviously. They're not Pete and Mary Health, but I'm going to protect them. But I think this is a really good example of accumulating assets and not knowing how to distribute them or what distribution is going to look like at the time. So you can see here they got cash in the bank of about $30,000, which is great. They have investment accounts right now of over $1 million. That's a current 401k that Pete has at his current employer, and a rollover IRA from a previous employer of about $230,000. Now, Pete is going to continue to work. He's 63, and so it's not time to shut it down yet. Mary is not working at the moment. We have a small loan on a primary mortgage, about $116,000. We're not super concerned about that, but maybe an early payoff is an option. And then we have a rental property at the moment, combined with their primary home, that's $1.2 million of real estate assets. The goals for Pete and Mary are Pete wants to retire at age 65, so that's in 3 years. They want to have a monthly retirement expense of $7,000. That's in addition to any mortgages that we've already entered in on that net worth screen. We have annual health care costs here in retirement factored in and long-term care costs at the end. They've had some experiences with their family where they've had to take care of aging parents, and maybe they want to protect from that themselves, but they might have to do it on their own. They want a bathroom remodel, they want to redo a roof, well, they need to, and then they want to go on a vacation every year. These are the goals that start when Pete retires. Right now, Pete has a good salary, about $235,000 and some bonuses, so getting close to $300,000, and Mary doesn't work, but she does a lot of giving back to their community. So they work together as a really good family unit and being bedrocks in their community. Pete and Mary are going to have Social Security, and since Mary doesn't have a great earnings record, which is fine, she's been a phenomenal homemaker, they have 3 kids, Mary is probably going to take 50% of Pete's Social Security, which we will show you in a couple minutes. Right now, the main savings is in the 401k to be able to take advantage of taxation now. But we're going to show you maybe some things that they could adjust moving forward, or at least think about. So we can see here that their pre-retirement living expenses are $8,000. That's not including what we've already entered in the net worth screen. But remember, their goal in retirement was to get their retirement expenses around $7,000. That's important. $8,000 in spending now with the high income, and then $7,000 of spending when they retire. That's a really key component to evaluate how to manage what to do next. And then right now their investment breakdown is broken up between 66% US equities, basically 67% US equities, 8% international, some emerging markets, some real estate, some bonds. They're broken up between 79% equity, 21% fixed income. That includes that cash. So they've got a more aggressive allocation. Some people are already biting their fingernails worried about Pete and Mary and their financial health. Well, you're going to notice this is important, but it's not the most important thing. And let me show you what that looks like now. So remember this screen that showed their probability of success, their probability of getting $7,000 a month with an inflation adjustment for the remainder of their life and paying for long-term care out of pocket is very, very low. And remember this tax screen where for the next couple of years are going to be in the 24, then 22, then 25, then 25, then 25% tax bracket, and then it's going to drop to 15. It's going to be in the 25% tax bracket. We can see how their taxes now and their taxes in the future can play into a lot of these answers. So let's go back here and let's make some adjustments. So right now, Pete wants to retire at 65. There's one of the really difficult things that I could tell Pete to do, depending on his particular situation. What if I said, hey, Pete, if you really want this money, $7,000 a month through retirement, what if I made you work an extra couple years? That little adjustment makes a substantial difference. And you want to know why? Is because that is 2 to 3 more years of contribution to a 401k and deferring distributions. On that distribution page, if they were really going to retire at 65, we're starting to pull money out right away. Now let's see what that looks in that tax situation. You can see it bumps up their taxes quite a bit. And in 2026, why does this number go up? Because the Tax Cuts and Jobs Act sunset, and in these tax brackets for these middle to high income earners, they're going to get more in their high marginal tax brackets due. But then it decreases, and then we see a little bit, but then it bumps back up later. These are required minimum distributions, which we'll get to in just a second. But regardless of all those taxes, oh man, we're paying more taxes. Our probability of success in retirement increases substantially because they were able to accumulate more assets regardless of the tax bill. So let's set this back to 65 and let's start to think about, well, what else could they do that might be difficult? What if I said your retirement monthly expense, we're going to decrease it to, let's say, $6,500 per month instead of the $7,000 a month. So a little $6,000 less per year. That helps a substantial amount. You just can't spend quite as much. But we don't want to do that. That's not what we want to do. So let's go ahead and put this back to $7,000. That's the goal. That's what we want to do. So we don't want to adjust that. Okay, so we're back at 7,000. The probability still doesn't look great. So let's think about, well, what if we paid this money differently? Right now, this is set up where our retirement spending is on an inflation adjusted method. We're just every single solitary year, we just inflation adjust your spending based on what happens out in the world and what inflation is there. So you want $7,000 a month? Well, we're just going to add a little bit to it. But that's not really a dynamic spending strategy that's built to help protect higher spending strategies in retirement. And you can see that here in their expense column. You can see their living expenses starts out at $96,000. They got a housing expense. Their house will be paid off in about 5 years. Rental and vacation homes, kind of some other expenses. But you can see here that an inflation adjustment just increases their spending on a gradual amount every single solitary year. But maybe that's not realistic. So what could we do differently? One thing I do is we use what's called the guardrails approach. This is a more dynamic spending strategy, and just this adjustment changes their entire outlook on retirement. It bumps them up from a 29% probability to a 64% probability. Do you want to know why? The reason for that is we spend based on how that high risk portfolio functions. Here's what I mean. The guardrails approach is literally like guardrails. Imagine a car on a road, or even better, the bumpers on a bowling alley. You know how we put the bumpers up? My 6-year-old likes to roll the ball and bounces down the bumpers. That's kind of how the guardrails spending approach exists, where we try to keep the ball on the lane, but we don't try to push the ball too far outside the bumpers unless the portfolio tells us to. So we spend every single year with an inflation adjustment, but when there are years when the portfolio does really well, we get a bonus. And we get the inflation adjustment plus the bonus where I say, hey, you go spend. And in the majority of the years, the market does better than it does poorly. But in the years that the market does poorly, we may take a spending cut. But that bonus and those cuts aren't implemented until the portfolio moves up or down a certain distance and a certain amount. So that's what we're trying to evaluate on a more dynamic spending strategy as opposed to just a straight line inflation adjustment. Just by doing this, it increases probability of success to be able to spend that amount of money, a substantial amount. But we're still not quite there. So what if I told Pete, hey Pete, let's just work one more year. I know you want to retire at 65, but let's try to find a way to work one more year. That creates a substantial change in our retirement outlook, where we don't have to adjust that $7,000 spending anymore. We get the ability to spend a substantial amount, the goals-based amount, with the new roof, the bathroom remodel, and those vacations on a regular basis, and being able to cover long-term care by making some of these adjustments. Now we just got to implement and make sure to monitor along the way. But now you're probably asking, well, what about Social Security? That's a great question. Let's talk about that for a moment. Right now, we have Pete taking his Social Security at 67, and then Mary applying for her spousal benefit at age 67. She's a couple years younger. But maybe that's not the optimal method. When we go back to particular Social Security strategies, because Mary is a few years younger, and we're talking about maximizing Social Security, potentially the best way to do that, the optimal strategy, is for Pete to apply for his own benefit at age 70, and then Mary potentially applies for her own benefit at 67, and then we'll potentially take the spousal add-on or 50% of the benefit when the time comes. Now I know this looks kind of deceiving by it saying applies it for own spousal benefit, but essentially what this is trying to say is apply for the spousal benefit, Pete's spousal benefit at that time. That's the maximum benefit that they both could receive at that moment. Pete's maximum benefit at 70 and Mary's benefit or spousal benefit, which is 50% of Pete's maximum benefit at age 67. This is the way to optimize Social Security in their particular situation. As you can see here from these withdrawals from the 401k or the IRA, there's a big withdrawal here. That's because Social Security hasn't kicked in. You can see right here in 2029 and 2030, the withdrawals needed from the retirement accounts decrease substantially because that's when Social Security kicks in. So in this strategy of making Pete work an extra year longer than he wanted to helps to reduce down the distributions from the retirement accounts to supplement that $7,000 a month income number that they need. Then you can see later, we did accumulate more. We're going to have big distributions for required minimum distributions, but according to this plan and strategy, it's okay. We can still distribute the amount you want, have enough left over, pay for long-term care, give some money potentially to the 3 kids, and pay for long-term care if you need it, as long as we manage this properly. So there's a lot of elements that go into this. So let's just do a quick review of what we talked about. Just because you have a lot of money in tax-deferred dollars, IRAs, and 401ks, does not mean you're dead in the water. In fact, it means you can have a phenomenal retirement. But there's a few things that we need to implement. One is a good Social Security strategy so you can maximize your benefits, especially if you're planning on living longer. 2, we need the proper investment strategy to make sure we can keep the bucket filled and growing long enough to help with that long-term longevity risk. Next, we're going to mitigate how much you can spend and when you can start spending it. Maybe you do need another year or 2 of accumulation, but let's go ahead and do it the right way. Then lastly, the income distribution strategy matters. How you distribute your income matters a substantial amount. You can't just go into retirement thinking you can go into these big pots of money and pull the money that you think you need out. Your probability of success decreases a substantial amount. I hope this was helpful. Thank you so much for watching. Please make sure to like and subscribe if you haven't already and you enjoyed this video. We'll see you next time. Once again, I'm Thatcher Taylor, founder of ProPath Financial and certified financial planner. If you're interested in seeing how we help our clients or implement these strategies that you saw in this video, please go to propathfinancial.com. That's www.propathfinancial.com to learn more, and make sure to say hi to me while you're there. We'll see you next time.